Hey guys, today I want to talk about why drawdowns are a necessary evil, why no matter what you do in trading, you're going to have to endure some losses. So the main reason why you should embrace losses is actually because if you never lost, your strategy would eventually erode away. Now let me explain this. So think about when you're making a trade and it's a profitable trade. Well, you bought, someone sold to you, and if the stock went up after that, you made a good trade and they made a bad trade. So it's a game where one person wins and another person loses. Now, over time, if you never ever lost, the person on the other side of your trades would either go bankrupt or they would stop taking them because they would be realizing that they were losing on every single trade. So say, for example, you like to buy oversold markets, and when the market gets sold off really, really hard, you buy, and then in the next few days, it almost always goes up. Well, eventually, people that are losing selling the market to you would stop doing that, and the opportunity would cease to exist because the market would never become oversold anymore. So that's why trading losses need to be looked at as part of the game. The other side, the people making bad trades, they aren't going to continue to do that in perpetuity unless they get rewarded for their actions once in a while, which means they are going to win and you will lose. If the bad players are constantly punished, then they're never going to come back to the game. If you go back and look at Warren Buffett's track record, you'll see pretty brutal drawdown periods where he lost a lot of money, he looked like an idiot, it looked like his value-oriented strategy wasn't working, and especially so in the late 90s when everyone was buying these hot new tech companies and ignoring the stocks that Buffett was in. But those losing periods is what kept his strategy working for the long haul. It's because people shy away from value stocks and they shy away from the value investing style when it's not quite working. And that keeps the strategy there and that keeps the edge there for him. And so over time, Buffett has been able to consistently extract money out of the market, but that's because value opportunities continue to exist. And those value opportunities continue to exist because other players are making mistakes in the market and selling stocks at bad prices to Buffett. So I know this concept's a little abstract, it's kind of hard to understand. So another way to think about it might simplify it down a little bit is to think in terms of a poker game. So let's say you have a winning poker strategy and every single weekend you go and you sit down with a bunch of guys and you're playing a poker game. Now, if you never ever lost on any single night because you were just so good and the luck always went your way, then that poker game will die out pretty quickly, right? So the other people playing against you, they would realize that, hey, every single time I play with this guy, I'm losing all my money, it's not fun anymore, and they quit. So in order for that game to continue, the fish or the bad players need to have some winning chances. They need to be able to walk out one night with a win and actually think that they're better than you and they beat you. And so that's why you in turn have to lose. So hopefully this puts a little more clarity around why drawdowns are actually a necessary evil of the trading process, and why for a long-term strategy to work, it has to have drawdowns. It has to have periods where everyone doesn't believe it, because that keeps it going. That keeps the edge there over the long haul. Thanks for listening, guys. Subscribe to the channel for more trading insights and tips, and I'll see you guys next time.